Welcome to Capital Allocation Lab. If you value disciplined, long-term thinking over hype, well, you're in the right place. Before we begin, please subscribe and click like to support more educational episodes.
We have a really interesting deep dive today. We're going to unpack one of the most fundamental exercises in investing, really. It's the comparison of similar businesses that end up being priced wildly differently by the market.
Right. And we're using 4 specific companies, almost like a lab experiment, aren't we? To study how markets price, let's call it glamour versus enduring value.
Exactly. Glamour versus value.
Our aim, as always, isn't about predicting the next market wiggle, not at all. It's about sharpening your judgment. You know, that ability to allocate capital with calm confidence across different market cycles, no matter what the current mood is.
And we're going to follow a pretty clear sort of 3-step logic here. Step 1, what did the actual businesses earn and own? You know, the objective facts on the ground.
The reality check.
Precisely. Step 2, how did the market at a specific point in history actually price those facts? What was the sentiment?
Okay.
And then step 3, what would a simple, straightforward defensive checklist have told us about the risks and rewards baked into that price?
We'll try to translate all those, sometimes dense financial tables and valuation metrics into plain English. And crucially, we'll stress test this whole framework later on by looking at a more, modern version of the same pattern.
Right.
It really proves the psychology stays the same, even if the names and technologies change, right?
Absolutely. So for our initial lab bench, we've got the original 4 firms: LCRA, Emerson Electric, Emory Air Freight, and Emhart. And the core lesson here, it's actually stunningly simple when you lay it out. The differences in their business, quality, their margins, returns, stability, yeah, they were noticeable, but honestly not extreme.
Okay.
But their valuations, they were absolutely poles apart. It just demonstrates the market's tendency to either completely ignore facts sometimes or, just embrace the spectacular enthusiasm.
So we're not aiming for pinpoint precision today. It's more about understanding the direction and the proportion, isn't it? We want to grasp what's genuinely robust versus what's just pretty good.
Mm-hmm.
And critically, what the market is pricing as, like pure, flawless, inevitable perfection.
Exactly. That distinction, that's where money is either protected or lost.
When you look at just one company in isolation, and maybe you read a really compelling 10K or an article about it, you inevitably get drawn into its unique story, right? The charismatic CEO, the exciting narrative, that's the seduction of the single story. It's incredibly powerful. And it's often what leads us to sort of rationalize paying steep prices. We think, this time, this story is really worth that premium.
That is, I think, the investor's greatest vulnerability. That singular focus lets the story completely overshadow the simple arithmetic. But a cross-sectional comparison, forcing yourself to look at, say, 4 fundamentally similar companies all at once, maybe 2 priced modestly, 2 really popular, well, that gives you an immediate, powerful dose of sanity.
It acts like a financial mirror, doesn't it? When you put them side by side, you instantly see how the multiples, the PE ratio, price to book, can just stretch way, way beyond any actual differences in the underlying business fundamentals.
Yeah, think about it like this. Maybe company A earns a 15% return on capital and company B earns 20%. Okay, that's a noticeable difference. B is better.
Sure.
But if company B trades at, say, 40 times earnings and company A is down at 12 times earnings, well, the difference in valuation, that's over 3 times the multiple. It's just fundamentally disconnected from the difference in the actual performance, which was only, 33% better returns?
So the market's pricing, psychology, enthusiasm.
Exactly. It's pricing psychology, not just the raw performance figures.
And that gap between the business reality and the market's enthusiasm, that's the whole story, isn't it? If you can somehow quantify that gap, you know exactly where your long-term protection, your margin of safety really lies. Or, conversely, where you might be making yourself fragile if that popular narrative suddenly changes.
Precisely. Your focus shouldn't be on trying to guess which of the 2 glamour stocks will win the future race. That's a tough game. Your focus has to be on quantifying that gap. What does the business do today? Its average earnings, its cash flow stability, and then how much future growth and perfect stability is the market already making you pay for right now?
Right.
The ultimate risk or the protection, it's entirely in that proportion. It's the difference between needing an Olympic athlete's performance just to justify the price versus just needing a steady, disciplined worker. It makes a huge difference to your potential outcomes.
Okay, let's get practical. Let's introduce the simple diagnostics we really need to run on any company, doesn't matter the industry. This is like a foundational checklist, the is of the business. Yeah. You can run pretty quickly to just ground yourself in reality before you even start talking about valuation.
Right. So the first check is profitability quality. We want to see how much money the business actually makes relative to the capital it really employs. We often look at earnings on tangible book value as a kind of proxy for return on equity. We deliberately try to strip out leverage and, intangible goodwill.
Get rid of the fuzziness.
Yeah, exactly. We want to ask, what's the real cash-on-cash return on the actual assets doing the work?
Okay, makes sense. Then we look at margin health, just a quick check of the net margin, right? That gives you a crucial reality check on the firm's pricing power. If a company is boasting about huge revenue growth, but its net margin is paper thin or bounces around all over the place,
Then they don't really have much leverage over their suppliers or customers, do they? They're just kind of busy, like a commodity processor, maybe.
dizzy but not necessarily profitable long term.
Correct. The third check is stability. This is about stress testing the business model itself. We calculate how much earnings fell in the company's worst single year compared to its average over the prior 3 years. We're looking for resilience here.
So a business that maybe only shrinks 10% in a recession is fundamentally safer than one that shrinks, say, 50%, even if their average growth looks similar.
Absolutely, that resilience matters. Then, critically, growth. It has to be looked at over multiple periods, and most importantly, it must be per share growth.
Ah, the per share point. Crucial.
Totally. A company can grow its total revenue at 20% a year, looks amazing. But if it's constantly issuing new stock to fund that growth,
Then the existing owner, their slice of the pie, isn't actually growing much.
exactly. They might only be seeing 5% per share growth, maybe even nothing at all if the dilution is bad enough. That distinction is absolutely vital.
Okay, what else?
We check the financial position. For asset-heavy firms, we're looking for a current ratio around 2 to 1 or better. That shows low short-term vulnerability. Debt needs to be conservative, manageable, and we have to meticulously look for things like convertibles or other stuff that might hide future dilution.
Sneaky dilution. Got it. And
Finally, 2 quick checks on, let's call it management culture. The dividend habit. Does the company have a long history of paying dividends? Continuity often signals a disciplined approach to capital.
and the stock's price history. Just
Yeah.
understand the kind of volatility you need to be psychologically ready for. So that whole list, that's the is.
That's the is. So how did our original 4 firms stack up on that first metric, profitability? Well, all 4 actually earned satisfactory returns on book value. 2 of them, Emerson Electric and Emery Air Freight, earned notably higher returns. And that absolutely justifies expecting, a somewhat higher growth rate from them.
Okay. Seems reasonable on the surface.
Yeah.
But you mentioned a trap earlier. This is where that flawless future trap springs open, right?
This is exactly it. It tripped up so many investors back then. When those superior returns are already well known, when everyone's talking about them like Emery Air Freight being the recognized air cargo growth story, the valuation often implicitly bakes in a future that simply must stay flawless. The market isn't just pricing the current high returns, it's pricing the expectation that the firm not only maintains those returns, but also scales them perfectly, without a hitch.
So you have to stop and ask yourself,
Yeah.
am I paying for what this business is right now? Or am I paying for a story about what it absolutely must remain for the next decade just to make this current price make sense?
Precisely. And if you realize you're paying mostly for that must-remain part, well, you've fundamentally eroded your margin of safety, haven't you?
Yeah, you've basically taken on the risk of disappointment yourself, if they stumble even a little.
You pay the price. That difference between the current reality and the mandatory expectation, that's the core lesson of the glamour trap.
Okay, what about stability? How did the 4 compare there?
That was interesting, too. 2 of the companies in that original group showed the remarkable feat of no decline in earnings in any single year over a full decade. 0 down years.
Wow, that's rare.
It is. The other 2 had mild dips, pretty much in line with the broad market during downturns.
That is genuinely impressive stability.
Yeah.
But I want to push back a bit. Is stability always the ultimate goal? Sometimes a cyclical business, one that gets hit but is deeply resilient and snaps back really strongly. Maybe that's a better buy if you get the price right.
That's a critical nuance, absolutely.
Markets do seem to overpay for that smooth-looking chart and maybe underpay for gritty resilience sometimes.
You're right. We're not saying you should only buy the smoothest chart. Not at all. What we're saying is that a resilient business, when you buy it at a reasonable price, often provides a much better owner experience over time.
Why is that?
Because that highly priced, perfect growth stock,
Hmm.
it's maybe just one disappointing earnings report away from a massive valuation reset, right? The air comes out of the balloon fast. Whereas the resilient company, bought cheaply, can absorb quite a few shocks without necessarily destroying your principal value. There's more cushion.
Got it. Okay, let's dig into the growth mechanism again. You said, per share, repeatable, and funded sensibly. Even the modestly priced pair in the original study, LTRA and MHART, they showed decent per share growth over time. They weren't just stagnant companies.
No, they weren't. But the crucial factor always is that starting multiple you pay. Imagine a company doing truly great, say, 15% annual per share growth. Fantastic business performance.
Sound great.
But if you buy that growth at a hyper multiple, let's say 45 times earnings, and over the next 5 years, the market's enthusiasm just cools off a bit, maybe down to a still high 20 times earnings.
Mm-hmm.
That multiple compression alone can completely wipe out the benefit of those great business results. It can lead to surprisingly mediocre returns for you, the owner, maybe even losses.
Ouch. Okay, flip side.
Flip side. You buy a steady business achieving, say, adequate 8% per share growth. Good, not amazing. But you buy it at a modest multiple, maybe 10 times earnings. Then, over time, the market realizes, hey, this company is actually much steadier and stronger than we thought. And the PE normalizes upwards, maybe to 15x.
Right.
That multiple expansion can essentially double your return profile. The price you pay compounds just as surely as the earnings do, either working for you or against you. Let's really anchor this in the cold, hard arithmetic of valuation.
Starting with the price-earnings ratio, the PE, it's really just the flip side of the earnings yield, isn't it? If you pay $30 for every $1 of current earnings, the stock trades at 30 times earnings.
Okay, and what does that 30x PE actually mean for me as an owner in terms of yield?
It means your earnings yield is simply 1 divided by 30, which is 3.3%.
Wow, 3.3%.
Yeah, that's your baseline return right there if the company just stopped growing today and paid out every penny it earned. To justify starting with such a low yield, you absolutely require future growth to be not just strong, but incredibly durable over a very long time.
You're basically demanding perfection just to hopefully get a decent return down the road.
You really are. Now, contrast that with a more defensive stock. Let's say one trading at 10 times earnings.
Okay.
The earnings yield there is 1 divided by 10. 10%.
Much better starting point. Vastly better. Assuming the underlying business is stable and the balance sheet is sound, that 10% yield provides a much, much sturdier foundation to build on.
That difference, what is it, 6.7 percentage points between 10% and 3.3%? That's huge.
It's an absolute gulf. It dictates entirely different demands on the future performance of those two businesses. If the 30x stock hits even a minor speed bump, that tiny 3.3% yield offers almost no cushioning effect.
Right.
But if the 10x stock hits a snag, that 10% yield still provides a significant immediate return, helping to offset the temporary issue.
And we see the same kind of extreme disconnect when we look at price to book value, right? Paying 1.0x book, that's easy to understand. You're basically buying the net assets, the cash, inventory, property, what they cost. It's your liquidation acre, sort of.
Exactly. But when you start paying the kind of multiples seen in those glamour stocks, 6 to 14 times book value,
Wow.
you are paying overwhelmingly for intangible expectation. You're paying for the market's belief in the company's superior ability to generate future earnings from those assets.
So the actual assets themselves offer very little downside protection at those prices.
Almost none. It means the company has to constantly keep reproving that high earning power year after year. The pressure is immense.
And this difference in the required expectation, it shows up immediately in the dividend yield too, doesn't it? Let's take your example. Two strong firms, both earning $2.50 per share, both paying out $1.20 in dividends. Okay. If firm A trades at $27, the yield is $1.20 divided by $27. That's a sturdy 4.4%. Feels solid.
Right. But if firm B, purely because of its great story and market hype, trades way up at $66, well, the yield on that same $1.20 dividend drops to only 1.8%.
Wow, that 2.6 percentage point difference.
Yeah.
It's purely the market's appetite for firm B's narrative, isn't it?
Purely. In the original comparison of our 4 E companies, the cheap pair yielded roughly double what the dear pair did. The arithmetic just doesn't care about how compelling your story is.
And you mentioned that dividend habit isn't just about cash flow. It's a huge culture tell. The firm in the study that had maintained an uninterrupted dividend since the early 1900s, That signals something deeper, doesn't it?
It really does. It signals a specific, ingrained management stewardship. Discipline, probably conservatism, a focus on treating shareholders like long-term partners,
Yeah.
not just temporary providers of fresh capital whenever needed.
Okay, now let's talk about that hidden danger you mentioned.
Yeah.
Hidden dilution. You said 3 of the original firms had classic, strong financial positions, current ratios near 2.1, looked good on the
And it
surface.
did. Good near-term solvency.
But one of them had a very large block of convertible preferred stock lurking on the balance sheet. Explain why that's a trap.
Ah, yes. Convertible preferred. It's a classic way for value to leak away from common shareholders without them always noticing immediately. It usually pays a pretty low dividend today, right?
Yeah.
So it makes the current income statement and balance sheet look deceptively clean. Doesn't look like much debt.
Yeah.
But it signals an absolutely certain future share issuance down the road whenever the stock price hits the conversion trigger point. More shares will be created.
So the pie gets sliced then or later on.
Exactly. Our defensive mandate here has to be really firm. You must treat likely dilution, whether it's from convertibles or recurring stock-based compensation, which is huge these days, or deep in the money options you have, to treat it as already real when you calculate your per-share earnings and figure out your margin of safety.
If you don't make that adjustment for pending dilution up front, what happens?
You set yourself up for this painful thing called valuation drift. You thought you were paying, say, 20 times today's earnings. But when those new shares inevitably get issued next year, maybe your real forward PE was actually 25x all along. You paid more than you thought you did, effectively.
Ouch. And you see this a lot with modern tech firms.
Oh, absolutely. It's a major issue with some hyper-growth companies. You often see truly impressive top-line revenue growth, but it requires constant share issuance to fund it. Every couple of years, they need to raise more equity to fuel the next round of expansion or acquisitions.
That's not really owner growth then, is it?
Not for the existing owners. We call it treadmill growth. The company is running incredibly hard, burning cash, issuing stock, just to keep the per-share economics for the existing owners roughly in the same place.
So the solution is demand better.
Essentially, yes, step off that treadmill. Ideally, you want growth funded primarily by the company's own retained earnings and maybe some prudent debt, not by constantly diluting the people who already own the business.
Okay, let's try to consolidate these lessons into that classic framework, the practical 7-point checklist. Think of this as your filter against falling into these glamour traps.
All right, let's run through them. Test number 1. Adequate size. We generally want a meaningful revenue base and market capitalization. Ideally in industries you actually understand. Size often provides a bit more resilience against minor shocks, and frankly, more visibility, too.
Makes sense. Test number 2.
Financial strength. For asset-heavy businesses, that current ratio near 2-to-1 is a good starting point. Net debt must be conservative, meaning cash flow can easily cover interest and principal payments. And critically, the company shouldn't be reliant on serial equity raises just to keep the lights on.
Okay, number 3.
Dividend continuity. Ideally, we look for at least 20 years of uninterrupted payments. That's a strong signal. Or for newer firms, especially tech companies that might retain all their cash for growth, we'd look for a really transparent and disciplined capital return policy, maybe focused on sensible, non-dilutive share buybacks when the price is right.
Got it. Number 4.
Earnings record. Simple but powerful. No deficits over the past decade. This tests true business endurance across multiple economic cycles, not just the good times.
Right. Test number 5.
10-year growth. We want to see at least 1/3 growth in per-share earnings over a full decade, and importantly, achieved with sensible capital intensity. The growth shouldn't require massive, continuous asset purchases just to stand still.
Okay. Growth per share, sensibly funded. Number 6 deals with assets.
Yes, price versus assets. For those asset-heavy, perhaps cyclical or more mature businesses, the rule of thumb is don't pay much more than about 1.5 times tangible book value. Think of that as your insurance policy if things go wrong.
But what about asset-light businesses?
Yeah.
That rule doesn't work there.
Exactly. For asset-light firms, we have to anchor the test differently. We'd focus more on owner earnings, the real cash flow, and the company's reinvestment needs and opportunities. We'll come back to that.
Okay, and the final test, number 7, price versus earnings.
Price versus earnings. The guideline here is don't pay much above 15 times the average of the past 3 years' earnings per share, EPS. And crucially, if the firm is cyclical, you absolutely must substitute that 3-year average with a full cycle average, maybe 5 to 7 years, to smooth out the peaks and troughs.
Right. Using peak earnings for a cyclical is a classic mistake.
Huge mistake. So that 7-point checklist, that's really the defensive investor's bedrock. But as you pointed out, we absolutely have to address modern reality. What about those asset-light firms? Software specialized marketplaces,
Mm.
where book value is intentionally tiny or maybe even irrelevant.
Yeah, the 1.5x tangible book rule just doesn't apply to a SaaS company, does it?
Not meaningfully, no. So the anchor has to change, but the underlying discipline must remain the same. For those kinds of businesses, you have to insist on demonstrably high, persistent returns on capital. Not just one good year, but consistent strength over time. And clear, verifiable, repeatable opportunities to reinvest that capital at high rates.
Okay, so high returns, good reinvestment. Then how do you anchor valuation?
Instead of tangible book, you anchor it to a conservative calculation of owner earnings. You have to estimate the true cash flow available to owners after all necessary capital expenditures, even the ones labeled growth capex if they're really needed just to maintain the competitive position.
Right, maintenance capex can be hidden.
It can. And then you must apply an extremely stern expectations check. Remember, these screens, the 7 tests, they're just the starting point for your research. They are absolutely not the final verdict on whether to buy or sell. Just a filter.
Let's talk a bit more about cyclicals. Because using the last 3 years, average EPS is completely useless if you happen to be looking at the very peak of a commodity boom, for instance.
Utterly useless, potentially dangerous. For those truly cyclical industries, think commodity producers, heavy manufacturing, transport, you have to basically ignore the current trailing averages everyone quotes. You must swap trailing for mid-cycle averages. That means testing the current stock price against the 5 to 7 year average of earnings, or even better, cash flow. That normalizes for the temporary booms and busts.
And when you do decide to buy into a cyclical, you need an extra margin of safety, right? Because you know that big earnings drop is coming eventually.
Absolutely. You have to demand stronger balance sheets, less debt, and significantly lower starting multiples compared to a steadier business. You need that extra cushion to compensate for the inherent volatility.
It requires a plan up front, doesn't it?
Yes, what we call a pre-commitment plan. Before you buy, you have to ask yourself, honestly, what happens if earnings fall 60% in the next inevitable recession? Will I panic and sell? You should only buy at a price that makes your plan, which should probably be hold steady, maybe even add more if the long-term case is intact, feel completely sane and comfortable even in that downturn scenario.
If imagining that 60% drop makes your stomach churn and think sell, then the starting price is too high. Or maybe the position size you're considering is just too large for your temperament.
Exactly right. Price and position size have to fit the volatility.
You know, the real genius of that original analysis, the LTRA, Emerson, Emory, Emhart comparison, is how those lessons just keep repeating, decades later. The chapter revisited the same pattern using 4 different E companies later on, just to show the market's fashion cycle operating in a completely different technological context. Still the same human behavior.
Yeah, that later lineup was fascinating. It featured the sober tortoise, again, Emerson Electric, still just humming along, steady business, modest multiple, reliable. And alongside it were 3 different flavors of high-growth glamour. There was EMC, the data storage giant, spectacular growth, but trading at a triple-digit PE ratio, paying no dividend.
Okay.
Then Expeditors International, a really well-executed logistics company, high returns, but still pricey.
I'll go third.
And the third was Exodus Communications. That was the pure dot-com bubble hyper-growth play. Massive revenue growth, building internet data centers, but also deep losses, incredibly debt-hungry, and treated by the market like an absolutely unstoppable miracle.
It's the perfect modern illustration of the glamour trap, isn't it? Why was EMC trading at triple-digit PE ratios back then?
Pure narrative. The story was that data storage growth was exponential, inevitable, unstoppable. The market basically believed EMC has secured a perpetual toll booth on the entire digital economy. Flawless future assumed.
And Exodus, same kind of story.
Even more so. They were riding the pure internet backbone wave, building the infrastructure. Revenues were growing at astronomical rates. The promise was they'd be essential for everything digital, the huge losses, the constant need to raise more capital. That was just waved away, ignored, seen as necessary investment costs for total market domination.
Risk becomes completely invisible when expectations detach that completely from balance sheet facts and actual cash economics, doesn't it?
Utterly invisible, until it suddenly isn't.
And we know how that story ended. The sober tortoise, Emerson, just kept compounding away, providing solid returns for its owners over the long haul. The over-celebrated hares Exodus collapsed entirely. EMC had amazing technology, but ultimately failed to meet those stratospheric expectations and eventually had to merge to survive.
The lesson for today is exactly the same. Your real protection comes from the boring, disciplined work. Sanity checking the actual profitability, the balance sheet, the price, versus some normalized measure of earning power. You have to maintain a process, a discipline. You can't rely on just picking the winning glamour stock out of the hat.
Let's try to turn this into a really tangible tool for listeners. That mini workshop idea, separating is from must. It seems like the best way to really quantify that risk-reward gap we keep talking about.
It's a brilliantly simple but powerful exercise. Just two columns on a piece of paper, or in your head. Column IS. Write down what the business already is. Its 5-year average return on capital, its historical operating margins, the real ones, its current debt level, its actual capital return behavior, dividends, buybacks, dilution. This is the verifiable past and present, the facts.
Okay, column 1. Reality, column 2.
Column muster. Here, you write down what the current valuation, the current stock price, implicitly assumes about the company's future. If the stock trades at 40 times earnings, well, it must grow earnings at maybe 15% or more perpetually, just to give you a fairly low long-term return. That's the hurdle rate built into the price.
Whereas if it trades at, say, 15x,
When maybe it only must grow earnings at, say, 3% or 4% sustainably to deliver that same eventual return. The required performance is much lower.
so if your must column reads like it requires perfect weather, no new tough competitors popping up, no economic slowdowns ever, flawless execution for management forever.
Right, if it requires perfection.
While your is column, the reality check is just, well, maybe it's good, maybe it's just average.
Yeah.
Then you know you're paying a huge hope premium.
Exactly. And hope, as we know, is not a reliable investment strategy. Never has been, never will be.
But conversely, if you find a steady business where the is column looks pretty sound, maybe high returns, decent margins, solid balance sheet, but the must, the future performance required by today's price, is mercifully low. Maybe only 5% growth needed.
Then you might have found something interesting. You might have found your margin of safety. The gap is working for you, not against you.
This brings us straight to temperament, doesn't it? Because all the technical analysis, the checklist, the is versus must, it's all useless if you don't have the psychological discipline to actually follow through.
Absolutely critical. We humans, we fall for so many traps. Like smoothness worship. We see a stock chart that just goes up smoothly, and we subconsciously assume that smoothness equals safety.
But it often just means it's already expensive, right? Everyone else noticed the smoothness too.
Often, yes. It implies a high price and maybe high expectations already baked in. And we definitely suffer from narrative overweighting. A really strong, compelling story, especially if it's delivered by a charismatic leader. Oh, that attracts capital like moths to a flame, sometimes regardless of how shaky the underlying unit economics actually are.
Yeah, the CEO says they're building the essential infrastructure for the future of humanity, and suddenly the fact they lose money on every transaction seems unimportant.
Exactly. The math just goes out the window. The antidote to narrative is always, always to drag the conversation back to the boring stuff. Returns on actual capital invested and balance sheet oxygen. Does this business generate real free cash flow? Does it need low capital intensity to grow? Or does the beautiful story require constant infusions of outside funding just to stay alive?
We also get fooled by silly things like split euphoria. Remember that? A stock splits 2 for 1.
And everyone gets excited.
But it changes absolutely nothing about the underlying value of the business you own. You just have 2 nickels instead of 1 dime. It's purely cosmetic.
Purely. The focus must always, relentlessly, be on the per-share economics after accounting for all potential dilution.
So how do we develop that crucial temperament edge? Any practical tips?
I think there are 3 really actionable practices. 1, write down your investment thesis, but write it so simply and clearly that, say, a smart teenager could understand it. If you can't do that, you probably don't understand it deeply enough yourself.
Good one. Forces clarity. Number 2.
2, pre-mortem the position. Before you even click buy, sit down and brainstorm all the ways this investment could go horribly wrong. Aim for at least 10 distinct ways, not just fraud or management incompetence, but think, how could new competition just crush the margins? How could a regulatory change completely alter the unit economics? How could technology make this obsolete? Force yourself to think about the downsides up front.
Love that. Builds resilience.
I mean.
And number 3.
And 3, diary your decisions. Keep a simple journal. Write down what you bought, why you bought it, your thesis, what specific price multiple you paid. your must check, and crucially, what specific information or condition would make you reconsider and potentially sell.
That creates accountability, doesn't it?
Yeah,
Stops you from rewriting history in your head later if things go wrong.
exactly. It prevents you from rationalizing mistakes after the fact. Oh, I knew that risk was there. Well, did you write it down?
That diary practice sounds key. And finally, that temperament check we touched on earlier about drawdowns.
Yes, absolutely necessary. If imagining a 30 to 50% drawdown, which, let's be clear, happens to even the best businesses from time to time, would genuinely compel you to panic and sell at a terrible price, then your position size is simply too large for your risk tolerance.
Position sizing has to control your behavior, not the other way around.
Perfectly put.
So where does this leave us today? We're in an era of, well, rapid tech cycles, AI excitement, but also persistently higher interest rates than we had for a long time.
Right. And this current environment, I think, fundamentally makes those old school virtues even more valuable. Things like balance sheet quality. Can the company survive without constant access to cheap capital? True, non-dilutive per share growth. And doing that stern expectations sanity check, the is versus must. These things matter more now, perhaps, than they did during the zero interest rate
The
period.
glamour trap pattern is absolutely repeating right now, isn't it? Just with different names and narratives.
It always does. So the advice remains the same. When the narrative gets really loud, when the hype machine is in full gear, the math you do needs to get correspondingly calmer and more disciplined.
Don't waste energy fighting the fashion or trying to short the hype. That's a dangerous game. Just sidestep it.
Exactly. Sidestep it by focusing relentlessly on quality and price. Accumulate stakes in businesses where the current reality already clears a high bar. High persistent returns on capital, good balance sheet. And where the future performance required by the current price is mercifully low, where you don't need perfection for a good outcome. That really is the essence of defensive, value-oriented investing. #tag outro.
So the enduring lesson from this deep dive into glamour versus value seems pretty clear. You don't need to be a brilliant stock picker or possess perfect foresight. You just need to be steady.
That's right. Choose sensible starting prices, insist on resilient balance sheets, and try to align yourself with management cultures that compound capital responsibly over time. Then let time, not market enthusiasm, do the heavy lifting for you.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.